Every empire reaches a point where strength is measured not by production, but by promises. At that point, debt stops being a tool and becomes the system itself. History shows this moment clearly. Even when names and centuries change, power expands faster than real capacity, and borrowing fills the gap. Stability appears permanent, because trust absorbs imbalance for a time. But trust is not infinite. When obligations compound faster than output, pressure builds silently beneath normal life. This is not a story about panic or prediction. It is about structure, limits, and moment a system begins revealing what it costs. The modern system is built on a simple inversion. Wealth is no longer generated first and borrowed against later. Borrowing comes first, and production is expected to follow. In this arrangement, debt is not evidence of weakness. It is the mechanism that allows expansion without immediate constraint. For the United States, this inversion became systemic rather than temporary. The ability to issue the world's primary reserve currency transformed borrowing into a form of power. Deficits no longer signaled imbalance. They became instruments of reach. In a traditional empire, limits appear when resources thin or territories resist control. In a debt empire, limits are delayed by credibility. As long as markets, institutions, and foreign governments accept promises as payment, expansion continues without visible strain. Bonds replace tribute. Interest replaces taxation pressure. Consumption replaces production as the primary signal of strength. The system rewards scale over efficiency and continuity over restraint. This inversion reshapes behavior across the entire structure. Political incentives favor spending today over adjustment tomorrow. Financial institutions profit from volume, not sustainability. Time 0.5s. Households internalize the logic by substituting credit for income growth. None of these actions appear reckless in isolation. Each is rational within a system that assumes permanent access to future capacity. The danger emerges precisely because the inversion works so well. When borrowing stabilizes growth for decades, it becomes indistinguishable from growth itself. Output no longer disciplines debt. Debt defines output. The empire no longer asks what it can afford. It asks only whether the system can absorb more obligations. For a time, the answer is always yes. That answer, repeated long enough, becomes the belief that limits no longer apply. This belief is the quiet pivot where history shifts from expansion to exposure, without alarms, without collapse, but with consequences already mathematically embedded into the structure itself. The core collapse mechanism of a debt-driven empire is not default. It is saturation. Collapse begins when accumulation outpaces the system's ability to justify it internally and externally. Debt grows faster than productive capacity, but more critically, faster than confidence in future adjustment. At this stage, the system does not fail because it cannot borrow. It fails because borrowing no longer resolves the distortions it created. In early phases, debt smooths cycles. It stabilizes demand, extends influence, and masks inefficiencies. Over time, however, it changes incentives. Capital flows toward financial engineering rather than productive investment. Returns are extracted from leverage instead of output. Risk migrates away from visible balance sheets into layered obligations that depend on continuous rollover. The system becomes increasingly sensitive, not to shocks, but to interruptions. The key mechanism is misallocation. When borrowing is structurally rewarded, price signals lose their disciplining role. Interest rates cease to reflect scarcity of capital and instead reflect policy objectives. Unproductive sectors survive longer than they should. Productive sectors adapt to cheap credit rather than real demand. Growth becomes broader but thinner, more impressive in aggregate numbers than in underlying resilience. As obligations compound, the system relies on expansion to remain stable. New debt is required not to grow, but to service existing commitments. This is the point where sustainability quietly disappears. The system still functions, markets still clear, and institutions still operate. What changes is the margin for error. Small adjustments begin producing outsized effects. Another layer of the mechanism is externalization. A reserve-based debt system shifts adjustment costs outward. Inflation, currency pressure, and financial volatility are transmitted beyond national borders. This delays domestic reckoning and reinforces the illusion of control. But externalization has limits. As foreign holders absorb increasing exposure, their tolerance becomes a variable the system does not control. None of this creates immediate collapse. It creates fragility. a structure that appears stable but cannot slow down without breaking assumptions it depends on. The system becomes locked into continuation. Reform becomes riskier than persistence. At this point, collapse is no longer an event waiting to happen. It is a condition already in place, unfolding quietly through balance sheets, incentives, and behavior. The system remains operational, but it has lost the ability to correct itself without amplification. History does not mark this moment with headlines. It records it later, as the point where reversal was no longer possible. History offers a clear blueprint for how debt-centered empires evolve once expansion outruns capacity. The pattern is consistent even when geography, technology, and ideology differ. In the late Roman Empire, military reach exceeded productive base. Coinage was debased not to fund growth, but to sustain existing obligations. Short-term stability was preserved, while long-term credibility eroded quietly. The system did not collapse when debasement began. It collapsed when confidence in the currency could no longer be repaired without contraction. A similar structure appeared in early modern Spain. Vast inflows of silver created the illusion of limitless wealth. Borrowing against future shipments became routine. Military campaigns were financed by expectation rather than revenue. Domestic industry weakened as imports replaced production. Repeated defaults did not end the empire immediately. They marked the point where lenders demanded higher compensation, reducing flexibility and increasing dependence on continued extraction. Power remained visible, long after structural strength had already passed its peak. In both cases, debt functioned as a bridge between ambition and reality. As long as expansion continued, the bridge held. When expansion slowed, the bridge did not collapse instantly. It strained. Adjustment costs rose. Political systems chose preservation of reach over restoration of balance. Each delay narrowed future options. The critical insight from these blueprints is timing. Collapse does not begin when debt becomes large. It begins when debt becomes essential to maintaining the appearance of normality. At that stage, leaders are no longer choosing between alternatives. They are managing decay while hoping for external relief. Another common feature is narrative control. Empires near their limit emphasize continuity. They frame instability as temporary, external, or manageable through policy. Structural constraints are redefined as technical challenges. This delays public recognition, but it also delays corrective behavior. When recognition finally arrives, adjustment must occur faster and under worse conditions. History does not show sudden endings. It shows long transitions where systems continue operating while losing adaptability. The blueprint is not about catastrophe. It is about rigidity. Empires fall not when they lack resources, but when their structures can no longer respond to reality without undermining themselves. Debt accelerates this rigidity by converting future capacity into present obligation. Once that conversion dominates decision-making, history's direction is already SE. Time ends out 0.3s, even if the destination remains unseen. The pattern unfolds in stages, each one appearing manageable on its own, but cumulative in effect. The first stage is leverage normalization. Borrowing expands during periods of stability and becomes embedded in baseline operations. What began as a response to crisis evolves into a permanent feature. Debt ratios rise, but because growth continues, concern remains muted. The system interprets continuation as validation. The second stage is dependency formation. Obligations created during earlier expansions require maintenance. Debt is no longer used primarily to invest in future capacity, but to preserve existing arrangements. Programs, institutions, and geopolitical commitments are funded not because they increase resilience, but because withdrawing them would create visible disruption. At this point, debt ceases to be discretionary. It becomes structural. The third stage is signal distortion. Price mechanisms lose clarity. Interest rates reflect policy decisions rather than scarcity. Risk appears lower than it is because interventions suppress volatility. Participants respond rationally to the environment presented to them. Leverage increases further, not out of speculation, but out of necessity. Stability is maintained by managing perception rather than reducing exposure. The fourth stage is capital misdirection. Financial returns become concentrated in activities tied to asset appreciation rather than productivity. Investment favors instruments that benefit from liquidity expansion. Long-term projects with uncertain payoff struggle to compete. The economy grows increasingly dependent on balance sheet expansion rather than output gains. Measured growth continues, but its quality deteriorates. The fifth stage is external reliance. Adjustment pressures are shifted outward through trade imbalances. Currency role, time and 0.3s, and global financial channels. Domestic stability is preserved by exporting volatility. This works as long as external participants accept the arrangement. Their participation is sustained by trust, habit, and lack of alternatives, not by intrinsic balance. The sixth stage is political entrenchment. Incentives align around preserving the existing structure. Any attempt to slow expansion is framed as dangerous. Reform is perceived as destabilizing, even when continuation increases long-term risk. Decision-making narrows. The range of acceptable options contracts around maintaining momentum. The seventh stage is sensitivity escalation. The system becomes increasingly reactive to small changes. Minor rate adjustments, modest demand shifts, or isolated disruptions produce outsized responses. Resilience has declined, even though scale has increased. Complexity replaces strength. The eighth stage is narrative reinforcement. Stability is continuously affirmed through language. Risks are described as contained. Imbalances are framed as temporary. Structural limits are reclassified as technical challenges. This sustains confidence but delays adaptation. The final stage is constraint recognition. This does not arrive as panic. It appears as hesitation. Foreign participants shorten maturities. Domestic institutions demand higher compensation. Policy tools lose effectiveness at the margin. Nothing breaks. What changes is behavior. Throughout these stages, the system does not collapse. It continues. That continuity is precisely what makes the pattern difficult to recognize. Each stage inherits the consequences of the last, while narrowing future choices. By the time limits become visible, the system has already committed itself to a path where adjustment carries higher immediate costs than persistence. At that point, history is no longer shaped by preference. It is shaped by sequence. The modern alignment of this pattern does not require prediction. It requires comparison. The structure described in history maps cleanly onto the present system because incentives, not intentions, determine outcomes. The United States occupies a position no previous empire held at this scale. Issuer of the dominant reserve currency, anchor of global financial liquidity, and guarantor of security arrangements that extend far beyond its productive base. This alignment alters the traditional constraints of debt, but it does not remove them. It delays their visibility. When obligations are denominated in a currency the system itself controls, adjustment can be postponed through issuance, rollover, and policy coordination. This flexibility is often mistaken for immunity. In reality, it is a mechanism for time shifting. Global demand for safe assets absorbs expanding issuance. Institutional mandates, trade settlement practices, and reserve management reinforce participation. This creates a self-reinforcing loop where scale attracts dependence, and dependence justifies scale. As long as this loop holds, expansion appears costless. The system's strength is measured by its ability to place liabilities, not by the discipline of its balance sheet. Alignment also reshapes domestic behavior. Fiscal decisions are insulated from immediate market feedback. Political cycles reward distribution over consolidation. Financial markets adapt by pricing continuity as the base case. Risk premiums compress, not because risk disappears, but because intervention is expected. This expectation becomes embedded across portfolios, institutions, and households. Stability is maintained through assumption rather than margin. Externally, alignment transmits pressure. Trade imbalance. Time 0.3s, currency exposure, and capital flow volatility are absorbed by participants integrated into the system. This is not coercion. It is structural participation. Alternatives exist, but they lack the depth, liquidity, and coordination required to replace the existing arrangement quickly. As a result, adaptation occurs at the edges rather than through rupture. What differentiates the modern stage is speed. Financial integration accelerates feedback. Small shifts in preference propagate rapidly across markets. At the same time, policy tools face diminishing returns. Each intervention stabilizes conditions but increases reliance on future intervention. The system grows larger, more interconnected, and more sensitive. Alignment also narrows perception. Because the system continues to function, its limits are interpreted as theoretical. Stress is managed through liquidity rather than resolved through adjustment. This sustains confidence, but it also accumulates exposure. The longer alignment persists, the more difficult reversal becomes without disruption. None of this implies imminent failure. It implies positional maturity. The system has moved from expansion to maintenance. Growth depends increasingly on balance sheet extension rather than productivity gains. Flexibility is preserved through credibility rather than capacity. This is not a judgment. It is a description of stage. History shows that alignment is not the end of empires. It is the phase where outcomes become path-dependent. Choices matter less than sequence. Once a system reaches this configuration, timing becomes uncertain, but direction becomes constrained. The structure continues to operate, yet its ability to adapt without amplifying stress steadily declines. The modern system has not broken. It has aligned itself with a pattern that has appeared many times before, under different names, with different instruments, but with the same underlying logic. Acceleration begins when stabilizing tools stop reducing risk and start redistributing it forward. At this stage, the system remains functional, but the distance between cause and effect shortens. Adjustments that once unfolded over years begin to register within quarters. Policy responses still work, but their duration shrinks. Each intervention buys time, not a resolution. The trigger zone is not defined by a single event. It is defined by interaction. Rising interest burdens intersect with slower real growth. Fiscal expansion collides with political resistance to consolidation. External participants reassess exposure, not because of fear, but because alternatives, even imperfect ones, begin to matter at the margin. Behavior changes before narratives do. Acceleration expresses itself through sensitivity. Debt servicing absorbs a growing share of resources, limiting flexibility. Market reactions become less forgiving. Liquidity remains available, but its effectiveness declines. Larger actions are required to achieve smaller stabilizing effects. This is not a loss of control. It is diminishing leverage. Time 0.5s. Triggers emerge from routine processes rather than shocks. A refinancing cycle that clears at higher cost. A policy adjustment that fails to calm expectations. A geopolitical demand that increases obligations without increasing capacity. None of these are catastrophic individually. Together, they compress the adjustment window. The system responds by leaning further into its existing logic. Issuance increases. Guarantees expand. Coordination intensifies. These actions stabilize conditions, but they also increase future dependence on the same tools. Optionality narrows. Reversal becomes riskier than continuation. What marks the trigger zone is not collapse, but constraint. Choices remain, but their consequences accelerate. Delays compound faster. Errors propagate wider. The system's scale magnifies every decision. Stability becomes a managed state rather than an emergent one. In this phase, visibility increases without clarity. Participants sense rising tension but lack a definitive signal. The system does not announce transition. It drifts into it. Acceleration does not mean failure is imminent. It means the margin for adjustment has thinned. History records this phase not as the end, but as the point where sequence overtakes discretion. The consequences of a mature debt system do not arrive evenly. They distribute asymmetrically, following exposure rather than responsibility. Adjustment does not target the structure that accumulated obligations. It targets the participants least able to reposition quickly. Purchasing power erodes before balance sheets contract. Volatility appears in access rather than availability. Credit still exists, but its terms change. Institutions closest to issuance retain flexibility longer. Those dependent on fixed incomes, delayed wages, or rigid mandates absorb pressure. First, internationally, exposure manifests through currency shifts, capital flow reversals, and funding mismatches. Participation that once provided stability begins transmitting stress back to the core. This phase does not feel like crisis. It feels like compression. Options narrow, buffers thin. Decisions carry heavier consequences. The system continues to function, but it functions by reallocating cost rather than eliminating imbalance. What becomes visible is not failure, but prioritization. Resources flow toward maintaining continuity at the center, while adjustment is pushed outward and downward. This is not malicious design. It is structural outcome. Debt systems resolve pressure by redistributing it through time, geography, and hierarchy. Those furthest from decision-making experience the effects first, while the system itself remains intact, increasingly rigid. and progressively less forgiving of error. The final distinction in every debt-centered empire is not intelligence, intention, or policy sophistication. It is position within sequence. Systems do not fail when participants lose confidence. They adjust when confidence must be managed rather than earned. Time G0.5s. At that point, outcomes become constrained by structure, not preference. The question history repeatedly leaves unanswered is not whether limits exist, but how long credibility can substitute for capacity. Debt empires do not collapse at a moment. They transition across thresholds where flexibility declines quietly and options narrow invisibly. Timing remains uncertain. Direction does not. What defines the end is not default or crisis, but the loss of voluntary adjustment. When continuation becomes safer than correction, the system has reached its historical limit.